Hello, everybody. Welcome to my financial statement analysis part 4. In this video, we're going to be taking a look at some accounting add-ons. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay, so what we're going to do now is we're going to take our two companies, Meta Platforms and Twitter, and we're going to identify those accounting add-ons. And the accounting add-ons we're going to talk about today are mainly going to be operating leases, stock compensation expense, and goodwill and intangible assets. Let's start with operating leases. And before I go any further in this video, what I'm going to do, we're not done yet. What I'm going to go through and do is I will go through and link this playlist to you. And in this playlist, you'll see that there are videos here on that will go more in depth in terms of what each of these different items are. So let's go ahead and take a look at the accounting add-ons. And this is how, if you're taking my class, I want you to go through and identify them. So what is an operating lease? An operating lease is going to be something where I've signed a lease agreement. And in the course of signing, so if I rent building space, what I'm required to do is I'm required to record an asset and a related liability. If I look at the balance sheet for Facebook, what you're going to notice is it says operating lease right of use assets. It's about 7% of the total balance sheet. What you're also going to notice here is that you have operating leases, operating lease liabilities current, and you're going to have over here operating lease liabilities non-current. And let's see if we have another current asset. So the reason why I'm pointing this out to you is I do not want you to go through, and if you're filing on behalf of a company, I don't want you to say, oh no, we're not going to show this. But if you think about this intuitively, this is causing a great American balance sheet gross up. What do I mean by that? If a company owns a building, so say a company owns a building, and we'll say that building is worth, I don't know, we'll say it's worth 15,000, right? And I lease out this building to Meta Platforms. And what Meta used to have to do before, and this is a few years now, but what they used to have to do is they would used to have to just disclose the future lease payments in their financial statements. These were what we would call operating leases. We do not own the building at the end of it. We would have the separation between capital and operating leases. Guess what? Now everything's a capital lease, or everything is going to be disclosed on the books. And why I call this a gross up is because, say, landlord asset, and then over here we have tenant. So we've got 12,155 as their assets, and then we have liabilities over here and we'll go through and dig out what the current portion is of the operating lease of right over here. So what effectively is happening here? Well, if the landlord owns this building outright and the tenant is leasing the space, we now have essentially a gross up of our collective American balance sheets. And I don't know what the amount is going to be, but if you added up all the operating lease right of use assets on all the publicly traded companies, you would probably be able to figure it out. And it's going to be just, again, it's not a real, in my opinion. I understand why the FASB decided to go through and why the SEC decided to go through and to put this on there. But I think they really neglected on the fact that it's really causing this gross up. I do think it should be fully disclosed, and in certain industries, people were taking advantage of this, but for our purposes, it's something that we want to back out. So let's go through. And so if you're taking my class, we're going to identify these accounting add-ons. So for the operating lease, my total assets for Meta platforms, I'm going to say it right eventually, as of 12/31, 12/31/21, 12/31/20. So my total assets as of 12/31/21 were 185,987. My total assets as of 12/31/20 were 159,316. So what I'm going to do here is I'm going to say less my operating leases. So my non-current operating lease amount is going to be, for the balance sheet over here, this is going to be 12,155,000,000. This over here is going to be 9,348,000,000. Now, my current operating lease liabilities, this is where we're going to have to go through and do some digging. So one of the things that we did when we were going through and doing our return on equity is we went through, we were looking at the more recent financial statements. So let's go over here to our sec.gov. And what I'm going to do is I'm going to look up Meta Platforms. I want to go to their most recent 10K. And what I'm going to look at is for in their financial statements. I'm going to go ahead and look at their now. So prepaid expenses and other current assets. This is about 4.6 billion. So what I want to do is I want to look to see if in this dollar amount, there's a current portion of the operating lease right of use assets. So let's go ahead and see if we can find that. We'll go ahead and do a find. Prepaid expenses. Let's go ahead and check this out. Okay. Nope. So let's try this one. Let's try over here. Let's now try operating leases. Okay. So let's go ahead, operating leases, and let's see if we have any kind of a an amount. Oh, here we go. Oh, this is exciting. So by going through over here and looking at, when we look at the present value of the lease liabilities, let's see if these numbers match up. So over here, we had our accounting add-ons. We had 12,155,000,000. Let's see where that we can get that one around. Oh, let's see here. Okay. Okay, so I think what I want to go through and do is I want to kind of say that, okay, the lease liabilities, current and non-current for my operating leases. Let's see if this matches up on my liability. So what I'm trying to go through and do is I want to see where, so we've got 12,746 and we've got 1,127. Okay, so this is what's going on to our this is what's going on the liability section of our balance sheet. And over here, let's see if we can find any other information. What I'm really trying to do is to see if I can find another asset. Okay. So I think what I'm going to do, a quandary. Okay. So what I'm going to do is I'm just going to take out the amount of the liability on the financial statements. So let's just go ahead and do it that way. So if I say over here, when I look at the accounting add-ons, let's go ahead and do it like this. Less the lease liabilities, current, non-current. So over here, my balance sheet for Facebook, current, non-current. And then we're going to have over here, we're going to have assets restated of 152, 114. For our lease liabilities for Meta Platforms, we're going to go over here and say 1,023,000. Over here, it's going to be 9,631,000. So let's say, instead of saying restated, let's say assets without lease, without operating leases. That's a better way to say it. We don't want to call it restated. That's going to start freaking out the SEC when they check out this video. I'm sure I'm already causing more panic for them. I'm just kidding. They have to do their job. Okay. So, and the reason why I want to take this out of assets is because, in my opinion, this isn't really an asset. That's my opinion. If you're doing this at home, kids, and if you file a financial statement and you violate GAAP, you're going to be in big trouble. But we're not doing that here today. What we're doing is we're doing financial statement analysis. So the first thing we're going to do is we're going to remove those operating leases. Now, at the same time, total liabilities, our total liabilities are going to be 41,108. And over here for the prior year is 31,26. And then we're going to say less the lease liabilities, current and non-current. So we're going to remove these from both our assets and our liabilities. So liabilities without operating leases. And as you can see, it looks significantly better for this company. The one more interesting one is check out Starbucks. Okay, so I've got my liabilities without operating leases. So that's our first, going to be our first step. Let's go ahead and also do this for Twitter. Okay, accounting add-ons. And let's go ahead and use our same formatting. So our total assets for Twitter are going to be 14 billion. Our lease liabilities current portion, we'll see if we get that over here. Operating lease life, well, there we go. Current 222. 177 non-current. 1 billion. And over here, this is going to be 819. And our total liabilities for Twitter. Okay, so our non-current. Okay, so now what we've kind of done over here for Twitter is we've kind of normalized our assets and liabilities for this part. So that's going to be our first accounting add-on. The next one I want us to look at to go through and do is to do our net income. So our next adjustment is going to be for stock compensation expense. Okay, so for our stock compensation expense, we're going to take our net income. And our net income for Twitter was 221,409,000, a loss. And here it was 1,135,000,000. And now what we're going to go through and do is add back our stock compensation expense. When we go over to try to figure out how to determine our stock compensation expense, what we're going to do is we'll go over here for Twitter. And the best place generally to find stock compensation expense is to go to our statement of cash flows. So let's go ahead and go to our cash flows. And the first thing you'll see right over here is we have depreciation, amortization expense, stock-based compensation expense. So this is 629,901. And that's in 629 million. And then over here, we're going to have 474,932. Okay. And with these add-ons, we're basically with this over here, we're going to add this back. So over here, net income, loss, adjusted. Okay. So what we're going to do now is we're going to go through and do the same thing, but for Meta Platforms. And so over here, our net income for Meta Platforms was 39 billion. Our net income for Meta Platforms for the year ended December 31st, 2020 was 29 billion. Our stock compensation expense for Meta Platforms, and again, the best place to go to find this is going to be in our statement of cash flows. And when we look at our statement of cash flows, share-based compensation, same as stock compensation expense, this is 9,164,000,000. And over here for Facebook, for Meta Platforms, this is going to be 6.5 billion or 6,536,000,000. So what we've done effectively here with our stock compensation expense by adding this back, we're now at a little bit of a different level of net income here. And this number, and as I was explaining in one of the earlier videos before, the reason why this is kind of becoming more and more of a critical number, especially for a company like Meta, is that when stock compensation expense is recorded, we're debiting stock compensation expense, but you're not crediting a liability. Rather, what we end up doing is we end up crediting additional paid-in capital. And to date, this additional paid-in capital has gone up primarily due to the stock compensation expense, not because of share issuances. So in my opinion, our retained earnings has been not fairly stating what is actually the amount of retained earnings. And because the stock compensation expense, in my opinion, is not really an expense, because you don't have to, it's, again, watch the other videos and hear me talk about it. Okay. So for our final add-on is going to be, or our final adjustment is going to be goodwill and intangible assets. And to explain why we're going to go through and do this for these companies, when we look at the price to book ratio for Investopedia, right over here, when we go through and doing is we're going to have to go through and say book value is also the tangible net asset value of the company calculated as total assets minus intangible assets and liabilities. So what we're going to be going through and doing is that we're going to remove goodwill and other intangible assets. So when we compute the price to book value, we'll have a little bit of easier way of going through and doing this. So right over here, less goodwill. And let's go ahead and do this over here for Facebook. So right over here, when we look at the balance sheet for Facebook, the goodwill is right over here at 19 billion. The intangible assets is over here at 634 billion. So these are really going to be the other two that we're going to be deducting. We've also kind of said that this right of use asset, this is also considered to be kind of an intangible asset. At least that's what I would say it is, if anything. So again, but we've already deducted that in our analysis. So our goodwill over here is going to be 19,197,000,000, and then 634 for the other intangible assets. Over here, this is going to be 623, and this here is going to be 19,050,000,000. Now, I'm not saying that this goodwill has no value. In fact, I think it actually has an incredible amount of value because of what Facebook has been able to do, or what Meta Platforms has been able to do with their goodwill. So assets as adjusted, or assets less intangibles. So over here, this will be 152. And so we're now coming down over here and we're further normalizing this. So let's go ahead and do the same thing with Twitter. And we'll give ourselves a little bit more room. So over here for Twitter, our goodwill that Twitter has is 1.3 billion. Their other intangible assets are 69 million. So our assets less those intangibles are about 11.3 billion. So less our goodwill for 2020. Balance sheet for Twitter, 1.312. And then over here, you've got intangible assets of, there we go. Okay. Now, in terms of talking about why do we go through and what, as we go through and look at these add-ons, I really want to encourage you to look at the other videos I have made in this regard. But the importance in terms of identifying these other intangible assets and these accounting add-ons is that, again, in my opinion, the leases are not really real. These are obligations, in my opinion, that should be disclosed in the footnotes to the financial statements. They should not be included on the front of the balance sheet. However, though, those are the rules that we follow by. And I would say that would actually be really for any kind of like a land lease or any kind of a space lease. If I'm leasing office space, that's really the way it should be recorded. Now, in terms of the goodwill and the other intangibles, that can be somewhat debatable. But again, if a company is going to be sold, this goodwill is just something we record as a result of acquiring another company. So when we look at the price to book ratio, when we're comparing the firm's market capitalization to its book value, what we're really trying to do is to get a better sense of really like what is that company truly worth. So there we go. In any event, I want to thank you for joining me here today. If there are other videos that you would like to see, please feel free to leave a comment. If you're not in one of my classes and you want me to take a look at the ratios that you've selected, please feel free to ask me such, and I will be happy to get back to you. In any event, have a great day, and I look forward to seeing you on the next video. Have a good one.